Not because my setup was terrible, but because my emotions were. That's when I realized something important. The market is not just numbers on a screen, it's human psychology, fear, greed, ego, and social pressure. If you don't control these, they will control your trades. Trap number 1 is called loss aversion. Loss aversion is a bias that makes a loss feel about twice as painful as a win feels good. Losing $100 hurts more than winning $100 feels satisfying. So what happens? You hold losers and you cut winners. You see a trade go slightly red. Instead of exiting, you think, it's fine, it'll come back. You don't want to feel the pain of taking a loss, so you delay the decision, you wait, you justify, you resize the chart, you zoom out, you tell yourself a story, and a small, controlled loss quietly turns into a big, emotional disaster. Here's the dark part. You're not holding the stock anymore. The stock is holding you. You stop thinking about probabilities. You start thinking about being right. You're no longer trading the market. You're trading your ego. So how do you escape loss aversion? You remove your future self from the decision. You decide your exit before you enter. You set a stop level based on your plan, not your feeling. Price hits that level. You're out. No debate. No negotiation. Because if you leave the decision to your emotional brain, it will always choose short-term comfort over long-term survival. Trap number 2 is FOMO and social proof. You open your phone, everywhere you look, someone is winning. Screenshots of profits, green P and L. I just doubled my account. Your brain starts whispering, you're missing out. That's FOMO, fear of missing out. And it's one of the most expensive emotions in trading. You chase a stock that's already up huge. You jump in, not because it fits your plan, but because you feel late. You see volume, you see hype, you see people on social media screaming to the moon. That's social proof. Your brain thinks if everyone else is doing it, it must be safe. But the market doesn't care what everyone else is doing. It cares who is early and who is late. FOMO makes you buy late. Social proof makes you feel confident right before you walk into the trap. And when the momentum dies, you're the liquidity. You're the exit liquidity for smarter money. So how do you escape FOMO? You replace FOMO with FOMC, fear of missing your own criteria. You don't ask, am I missing this move? You ask, does this match my plan? If the answer is no, you let it go. You remind yourself, missing a trade will never blow up your account, but chasing the wrong one can. Trap number 3 is scarcity and false urgency. This one is everywhere. Last chance, limited time, only a few spots left. You see it in marketing, you see it in trading alerts, you even see it on your broker's app. Breaking news, don't miss this move. Scarcity makes you feel like opportunities are rare. Urgency makes you feel like you must act now. Combined, they shut down your logical brain. You stop asking, is this a good trade? You start thinking, if I don't take it now, I'll regret it. So you rush. You don't size properly, you don't check the risk, you don't even read the chart clearly, you just click buy. Then the candle reverses and you ask, why did I even enter this? The answer is simple. You didn't enter because of your strategy, you entered because of the timer in your head. So how do you escape this trap? You flip the frame. You tell yourself, if a trade only works when I rush, it's not a high-quality trade. You build a simple rule. If I feel urgency, I pause. If something feels like now or never, it's almost always never. Good trades will still be good after you think for 30 seconds. Trap number 4 is commitment and averaging down. This one feels smart until it destroys you. You enter a trade, it goes red. Instead of cutting it, you add more. You tell yourself, I'm lowering my average. This is how pros do it. But often you're not averaging into a strong setup. You're averaging into a bad decision. Psychology calls this the sunk cost fallacy. The more time, money, or emotion you invest, the harder it becomes to walk away. You don't want to accept you were wrong. So you commit even harder. You keep adding. You keep hoping. You keep telling yourself, I'll get out when I'm back to break even. But break even is not a price. It's a feeling, and the market doesn't care about your feelings. So how do you escape this trap? You separate trade management from ego management. If you want to add to a position, it must be part of the original plan, not a reaction to pain. You ask, would I open this same trade fresh right now, at this size, at this level? If the honest answer is no, then you shouldn't be.